Good morning, folks. I hope you've had a great week. I've had a great week. Weather's been lovely in Bangalore. So today I want to speak to you about six topics. Okay, Jane Street, that has been hogging the headlines. A little bit about what's happening to private capex, NTPC's nuclear dreams, and what is happening to the BFSI sector. Let's have a look at that. Then China's attempt to choke off India, and something on what's happening to US tariffs, what's happening with US tariffs in the rest of the world. So let's go. Jane Street is a global major in options trading and algo-driven trading. Their global profits are close to $20 billion only out of algo trading. So SEBI has been investigating Jane Street in India for allegedly manipulating the index for their own gains and manipulating stocks for their own gains. So their India profits are close to 36,000 crores, and SEBI has decided to fine them 4,840 crores at least till the investigation is complete, and let's see what happens then. So what has Jane Street been up to? They are large derivatives traders. So whatever positions that they have been taking in options, they're sort of been manipulating the index such that they are ensuring that their positions in the options that they've taken are profitable. That doesn't sound straight. That's what the regulator thinks too. Okay? But this is what has been happening. But I wonder if close to 10 or 15% of their annual profits come from India, but India's market cap is nowhere close to that scale. So it does seem to say that we are suckers. The options trading, the number of options traded in India is apparently amongst the highest in the world. But our market is not the largest in the world. It is not the deepest in the world. Even then, you have the highest number of options being traded here. Last year, SEBI had done a very interesting report. They were trying to figure out how many speculators actually make money in the futures and options space. And not surprising to me, the report said that 9 out of 10 options traders lose money. So I would tend to think that the 1 out of 10 is probably Jane Street. And if Jane is doing so much, making so much money, creating so much chaos, I shudder to think what Tarzan does. And if you don't get this joke, please talk to your father and he'll tell you about Tarzan and Jane. So there's an interview with Rajiv Memani, who used to be the chair of Ernst & Young, and now he is the president of the Confederation of Indian Industry. And while it's a larger interview, there's one particular question I just want to draw your attention to. And the interviewer was asking him that the latest data by the Center for Monitoring Indian Economy shows a dip in private sector project announcements in Q1. Why are we not seeing a pickup in private capex, is the question to Rajiv Memani. And his answer is a bit different. He says, in the last 3 years, private capex has actually been doing well, way against the normal perception that private capex has not picked up. The narrative has been that it is the government that has been doing all the capex and the private sector has been worried. But Rajiv Memani does have a different view, though he has not given any numbers here in the interview to support this argument. Okay, though he agrees that the last 4 or 5 months has seen a slowdown in the committing capex because of the uncertainty around geopolitics and tariffs and what they would do to our economy. That is acceptable. Okay. And he says the financial risk-taking capacity of entrepreneurs has come down. They do not want to be sitting on a lot of debt, given the uncertain environment. And as you all know, if you take too much debt and you're not able to do the business, you're not going to be able to service the debt. And the business environment does look a bit iffy till we know what's happening with the US tariff game. Okay? And he does flag the issue of availability of manpower. And even elsewhere, he's been talking about skilling as a compulsory requirement to ensure that we have enough manpower to support our manufacturing ambitions as a country. Okay. And finally, he says for micro, small, and medium enterprises, MSMEs as we call them, the availability of capital is a big challenge. Okay. But then we have been seeing actually in RBI's financial stability report that came in, MSC credit growth has actually been good. And there's an editorial here later on in the papers, and T.T. Ram Mohan argues that we've been having very good experience with MSMEs. Okay, so let's see what the data says. Okay. So he says MSME lending could be the new driver of credit growth. All right, and over the years, the MSME credit growth has moved from 13% to 17%, and then a slight dip to 14%. But in terms of NPAs, gross NPAs of the MSMEs have come down to only 3.6 from almost 9.3%. Okay, so we need to see this in the light of what's happening to banks in general, and that is the next news article in the papers. It says muted loan growth, margin woes may weigh on listed banks' profits. So the Q1 results of banks have not been so great as compared to the Q4 of last year. Especially private sector banks have seen a lower revenue growth and a lower profit growth, whereas public sector banks have done far better. Why do you think this has happened? So, going by whatever data that I've been seeing, it does seem that the private sector banks did make a good amount of profit in the first half of the year or the first 3 quarters of the year through unsecured lending, retail lending, microfinance, lending to microfinance companies. Okay, banks don't take a direct exposure to microfinance; they do it through NBFCs or through banks who specialize in microfinance, and these are all very high margin areas. But since this was going way out of control, the RBI did step in last year and asked banks to have a much higher coverage if they were doing retail lending or microfinance. And that was good. It took some froth away, it took some heat away, and banks came back to their feet on the ground and have reduced their lending to unsecured borrowers and retail. And that is what could have possibly shown the lower overall growth in the last quarter. Okay. The public sector banks don't do so much of this, and that is why their profit growth and their revenue growth is remains consistent with the previous quarters, and they've been doing better actually because of this anomaly. But I think this is temporary, and within a couple of quarters it would set right again. The other worries, of course, as far as the BFSI sector is concerned, is reducing NIMs. Okay, if loan growth is going to be less, and they will have to lend at lower rates, then what? Will they be able to collect enough deposits to sustain their loan growth at whatever rate it is? Because right now they're sort of just keeping up neck to neck. It's not been that easy for banks that they have excess of deposits to fund loan growth. Both have been a challenge. Okay. So, of course, why has loan growth been a challenge? While it does say that loan growth has come down to maybe 9% only as compared to a double-digit number in the previous year, it could be that a lot of companies have been raising capital directly from the bond market. It's good in a way because they're able to access the market directly and reduce arbitrage costs. But it's not great for banks because this arbitrage was the way they could make their money. And there are pros and cons for the people who are raising, the companies who are raising the funds. It's great that they're removing arbitrage costs and reducing the friction, and they're able to raise funds directly from the bond market, which makes the bond market deeper. But as long as it's only institutional players in the market that lending to companies, is safe. Retail players may not be able to distinguish or discriminate as well between a good borrower and a bad borrower. So I think one has to be a little careful on this, and especially in the light of a number of fixed income bond/deposit online platforms that have come up, which are making it easy for retail investors to subscribe to bonds by NBFCs and companies and anybody in the bond market, right? So they may not be able to distinguish and discriminate as well, and they may only go by the rate of interest that is being offered by the borrower. And if it looks high, they think it's good. But remember, if it looks high, may not be a very credit-worthy borrower. But not all retail investors can distinguish and discriminate. I still think mutual funds would be a better option, a safer option in this kind of a situation. Okay, and I did skip a little bit. NTPC has floated tenders for the nuclear plant ambition. So what they want to do is increase India's nuclear power generation. So in the just a few months back, they floated a tender, a global tender, to build new nuclear power plants in India. And the idea is to install 15 gigawatts of new nuclear capacity, which is twice our installed capacity at the moment. Okay. And also by 2047, the government's idea is to have 100 gigawatts of installed capacity from nuclear energy. You can imagine this has a lot of implications. Nuclear energy does not have the stigma that it had earlier, and it's fairly clean energy as compared to thermal and oil, as long as we are able to dispose of the spent uranium properly. And I don't think that is as much, nobody is breaking the rules there. One has to be very careful. But it gives us a lot of energy independence. We do not have to depend on oil imports. Just like the government has been focusing a lot on renewable energy, which is now a large component of the energy being produced in India. Add to that nuclear energy, and I think our independence will be far, far greater in the future, and will not be subject to the Western nations' eccentricities, like the US president who just declared last week that he would impose a 500% tariff on countries who are importing oil from Russia. And we all know that India has about a 35% of our oil coming in from Russia. While you may argue that the discounts on Russian oil are not as much as they were last year, but still they are a cheaper source. And as a sovereign nation, it is our right to import from whichever country we choose to import. Our relationships are our choice, not to be dictated by another country. So this is why we need to be independent. Of course, we've had a good run as far as oil prices are concerned last couple of years. And going by global growth, oil prices should remain soft. Demand should remain soft, but it is geopolitical issues, wars here and there, tariffs, and such unnatural events that could make oil prices volatile. They have been volatile last few months, and it continue to be volatile. But just imagine if we stopped importing oil from Russia and we had to import from elsewhere, our oil costs would go up. And as India argues, if the Russian oil were not in the market, in the global market, then oil prices would be far higher than what they are today. A question to ask yourself, who would benefit from far higher oil prices? For one, I would think that is the US. Their production costs are a little higher, and only if oil prices are higher is it economical for them to produce oil and sell it to the rest of the world. So higher oil prices, definitely a positive for the US oil producing companies. Possibly the US president has an eye on that also. We cannot put it beyond him to be able to be doing this. There was some strange news last week that China instructed Foxconn to recall all the Chinese employees in India, and a few hundred employees left India and went back to China from the Foxconn plant. So these Chinese workers were here in India to train the Indian Foxconn employees in the assembly of iPhones for Apple. So what China is apparently trying to do is choke off India. They know that a lot of global companies want to move their manufacturing to India instead of China. And China is playing hard. They're very frustrated, is what I can gather, because this is a short-term battle. They cannot win the war with such a move, because obviously we are going to get the workers trained elsewhere. It may take a little more time, but the transfer of technology will happen. And this only shows that China is becoming more and more unreliable as a manufacturing partner. You think global manufacturers would have the same amount of credence in China if they thought that China would arbitrarily make moves like this and restrict their independence? Nobody wants their independence to be restricted, least of all in the capitalist world. So this issue of China trying to choke off India uh, may backfire on them, because if the rest of the world becomes independent, I mean, if India also becomes independent, then we don't need China. In this entire rare earths saga, where China is not allowing India to import rare earths from China, and we are not able to make our magnets for automobile or defense production, who knows? India may figure out a way to manufacture these motors without those rare earth magnets. Then it will be far more. This is what China did. When the US imposed sanctions on China, and China became independent of America in that respect. So necessity is the mother of invention, and I think this could happen in India too. It's good for us, definitely good for us, and not good for China. China is trying hard to show its dominance in this part of the world and the rest of the world, but somehow does not have the same clout as Ajay Shah says in his article, Choking China Plus One. Okay, it does not have the same clout as the Western world in global economy and global geopolitics. And one reason is technology. Okay? The US remains the bedrock of technology, and the rest of the world would find it far more harder to work without American technology. They can work without Chinese technology, but they cannot work without American technology. So you get the difference. So whether it is as Ajay Shah states, the ASML EUV lithography machine, which is critical in making chips, okay, or the F-35 Lightning II fighter, or the computations that go on inside Google, and the kind of the way Google drives the rest of the world. And the rest of the world can't live with them. So I hope China is reading this article and figures out a way of better working with the rest of the world. I mean, in any case, we see that the rest of the world is becoming very, very polarized. We cannot blame only China. Many other countries are behaving in a very arbitrary manner. And coming to the last point about US tariffs on Russia, we've spoken about what they want to do with Russian oil. And July 9th has come by and passed. And the US president did send out love letters to many countries and telling them what are the level of tariffs that the US is going to be imposing on them, very, very one-sided. Number of them were small countries, but there were two large economies there, South Korea and Japan, on both of whom a 25% tariff has been imposed. All right, and then a 35% tariff has been imposed on Canada. So these three large economies that matter. He's still negotiating with the EU and India. Let's hope for the best. And at least I do hope that the deal would favor India. We are negotiating hard, and we still don't have any feedback from the US. What information we get is that the deal is being decided. It's on the table of the US president. He is yet to sign it. And we know that is a whole ocean. If he's yet to sign it, things could change very easily. Okay. So that's all, folks, for this week. Have a great weekend.